was an interesting quarter, the first quarter of 2018, and in stark contrast to what we saw through 2017. The biggest change that we saw was a pickup in volatility, and that really sort of came about in the beginning of February after a strong January start. What that was really driven by was growing worries about what was going to happen to interest rates, and then later on in the quarter, worries about sort of what would happen as a consequence of Donald Trump's trade programs. So all that really contributed to more volatile markets and a much more difficult environment for investors. The increased volatility that we saw in markets meant it was a more difficult time for investor returns. However, the portfolios held up pretty well. And the main reason for that was the heightened levels of cash which they've held for some time now. And we expect that those heightened levels of cash are going to be important because if we continue to see more volatility over the coming quarters, that will allow us to buy into markets at more favourable levels. As I mentioned, the portfolios continue to hold high levels of cash, and that will be important in terms of being able to firstly protect capital if volatility continues, but also to redeploy into markets if better opportunities come along. In terms of the sector and regional exposures for the portfolio, we continue to have big exposures towards both emerging markets and Japan. We think both those markets will do better than the other markets like the US, which are dominated by the heavy exposures to the tech market, as well as sort of materials, which we think will see more difficult times through the volatility that we're seeing. And also I think at a sector level, we think some of the more defensive sectors like telecoms and healthcare, they will continue to hold up well if this volatility continues to play out. But I think sort of in all that, if despite the heightened volatility, we see the portfolios in a good position to continue to deliver on their investment objectives.